Yeah, that's right, Peter. It is something that comes every year, but it always amazes me is how people procrastinate in trying to do tax planning.
We are in the thick of tax prep season. Some people are proactive, they want to get them done. Some people procrastinate. Regardless, just about every income earning American is going to need to file a tax return. What are our opportunities? What do we need to be thinking about? Today, John Kuykendall, as always, will keep us financially focused and give us tips and insights on how to be efficient, effective, and pay the least in taxes right here on the program. So glad you're tuned in. And of course, GulfCoast Financial Services proudly presents this program. They have been named Best of the Best in Financial Services 10 straight years and running by the readers of the Lake City Reporter. Founder and CEO John Kuykendall here with us, providing the information, keeping us financially focused. John, taxes are a constant thorn in our side and an annual event that we all have to kind of push ourselves through.
Yeah, that's right, Peter. It is something that comes every year, but it always amazes me is how people procrastinate in trying to do tax planning. Um, we just met with a client the other day who cannot understand why they have to pay taxes. But I mean, we don't make any money. But the problem is they had now almost $90,000 worth of income and had only taken out 3 or 4 thousand in taxes. So naturally, it's a progressive tax, and you're going to end up having to pay more. We offer a service to all of our clients that we will review their taxes in November, October, November, and then make adjustments as we need to whether we need to send an additional withholding or whether there are some things that we can do, IRA contributions, whatever, to take some of the hurt out of paying the taxes. But people put it off, Peter.
Yeah. Well, there's an old saying, John, strike while the iron is hot. I think that probably has a reference to blacksmithing at some point in time, but it's come to mean like seize the opportunity while the opportunity is there. So as you are helping people review those tax returns and the tax situations and the withholdings and looking at the investments with taxes in mind, what kind of opportunities are you helping people to identify, helping them realize and execute, or just see that people are missing?
Well, the one thing we try to do is, especially for those that are using the itemized deduction, because the itemized deduction now is 29,200 this year. Plus, you get that old folks credit of $1,550
There's
for
an
married
advantage to
taxes.
getting old, yes.
Yeah, yeah, it is over $30,000, and it was estimated back in 2017 when we put these tax laws into place that about 80% of the taxpayers wouldn't be able to do deductions anymore. We wouldn't be able to itemize. And that's really held true, Peter. It's most of the deductions we cannot use because the standard deduction is higher than any amount that we would have to itemize unless you're still working and have a business. And so we look at that standard deduction. So if we're not going to be able to itemize, we do the qualified charitable contributions where we take the monies, if you're over 70 and a half, out of your IRA, give them to the charities directly. It doesn't count as income. You don't get the deduction, but you can't write it off anyway. So those are some of the kind of things that we look at. We can deduct income tax, state and local income tax, residential taxes up to $10,000. And that's been a real hot button in some northern states.
Although Florida probably not as big of an issue, right?
No, Florida it doesn't hit us that much. I mean, some of the multi-million dollar homes, of course, would, but we're not
There you
like
go.
Los Angeles or California, where everything, or New Jersey. New Jersey has a tremendous amount of taxes. And so they could write off a lot more. But in Florida, that really hasn't been a problem for us. But certainly it's something that we should look at. If you own a home, the mortgage interest is deductible, things like that. So,
Is that one a wise one, John. And the reason I say that is because I hear a lot of people saying, well, I have a mortgage, or I'm keeping my mortgage, or I'm not paying off my mortgage for the deduction I'm getting. Number one, because of that large standard deduction, you're talking about this is an either or thing. You get
Right.
the standard or you itemize. So number one, are people even getting that mortgage interest tax deduction? And then doesn't the math work out that we're paying the bank more than we receive in benefit from the taxes anyway?
Well, if we're looking at it strictly from the tax benefit, Peter, then there are, in some cases, it just doesn't make sense. But if we're looking at it from the arbitrage situation where I'm paying three to the bank and I'm earning five, six, seven, eight in my investment account, why would I want to take the money out and pay that mortgage off? And two, don't forget, these tax laws are subject to change at any time.
Mhm.
So, and we know that by the end of this year, we're either going to get an extension on what we have or they're going to make changes. And so certainly it's one of those things that you need to be flexible about, but each individual person is different. And if you've got your money in a 2% savings account, then you might want to pay your mortgage off.
All right. Well, I go both ways on that. I hear it both ways, and I just always felt like, well, if you're paying the bank four times more because you just hate paying the IRS, then okay,
Yeah.
personal decision. But I did not factor in the arbitrage, right? What you could be making with investments versus what paying off the mortgage. So that makes sense. I know another big thing that people talk about kind of last minute that can help us with our bill from last year are those retirement account contributions, John, the
That's right.
IRAs and such.
And you should, you can always take, that's why I said if you started in October, September, October, November, then there are some things we can do at the end of the year, like up our contributions to our SEPs, our contributions to our simple plans, our 401ks, so that we can limit our income. Those are all things that we can do. And then if we still have somebody at home who's not in a retirement account or somebody who's working that's not in a retirement account, certainly we can do the individual retirement accounts and deduct that $7,000. Sure.
Yep. And you can do that for spouses,
Yes.
spousal IRAs. You can do that for last year still up until April 15th or the time that you file. You can still do it for this year. So a lot of opportunity maybe to double and even quadruple up on if you want to get a whole bunch put into retirement accounts. Like we do have opportunities to do that. But all of those things, John, those are last year. Now, as you are working and talking with clients that are either having a pain with taxes, are getting a bunch back, or are owing a lot, do you also help them to understand how to make those adjustments for next year?
Well, yeah, Peter, we're looking at Roth conversions because, we can do a Roth conversion, pay the taxes now, but certainly in the long term, that money's going to grow tax free. And if we all agree that we're going to be in higher income tax down the road, then certainly it makes sense to take that money out of those deferred accounts and go ahead and pay the government now and kind of keep it in the, in a bracket that we can live with, and do some planning that way. And certainly it makes sense to do that prior to age 65 when we go on Medicare, because our Medicare, of course, is indexed for income, the Part B. So we want to make sure that we do those ahead of time. Non-qualified assets in a tax efficient manner. If I'm paying interest every year on my savings account, I can get basically the same yield in both cases and defer the interest further down the road by using an annuity. So that's something that a fixed annuity, something that I might consider. Those are all things that we look at, just to make sure that we got everything covered.
That's a big one if we've got a large amount in that taxable interest box, right, John?
Yes. hmm Yeah, and a lot of people do. They have a taxable interest, even in their brokerage accounts. That money is going to be taxed every year, and so if we have a lot of money in that, there's some things we can do to adjust that, and give us better arbitrage.
And that's making adjustments for next year and for future years, right? I mean, when
Yeah.
we're filing the returns, we're looking back at last year. So if we're making these adjustments now, that would be for this year and for the bill next year. But the Roth conversions in particular, John, that's one for like all of the years into the future. That's very forward thinking, correct?
Oh, yeah, Peter. You got to remember, Peter, that if we think that I've got $1 million in my 401k, I really don't have $1 million. I've probably got like $700,000 because I'm in 30% tax bracket. I owe that money to the government now. That could be 40 or more in the future. So, do I want to go ahead and hedge that and bet that the government's going to spend less? Or do I want to try to figure out a way to go ahead and do some things now that's going to put me in a lower tax bracket?
Well, again, we are talking about tax opportunities and striking while the iron is hot, things that you can take advantage of. And we are speaking with John Kuykendall, your source for a common sense approach to planning proactively for your financial future and staying financially focused, well, tax opportunities specifically. And John, wanted to talk about a couple specific vehicles. And you mentioned the annuities, you mentioned the Roth. Life insurance also can potentially have some tax advantages. And I know that there are different types of life insurance and that there is some debate over them, but run down for us. How does life insurance work into the conversation of being tax efficient?
Well, the thing about it is, Peter, is life insurance has got a bad rap. It's kind of almost, it's a little worse than annuities because when we originally sold life insurance back in the day, I'll say, we sold it for the death benefit. We buy the insurance so that when you pass away, you're covering your debt and helping your heirs out so that they can continue to live the way you wanted them to when you left them. But life insurance is more than that today. It's if I die, if I live, or if I have a confinement, because most of the policies now all have critical illness riders with them, where I can get a percentage of the policy now to cover long-term care, cover needs for if I'm incapacitated, and not have to pay taxes on that because I'm taking a loan against the policy. The policy's still in force. So there's a percentage of the policy that's kept going. The majority of the death benefit is paid out up front. That's certainly one way, Peter. The other way is the cash value. These policies now are like fixed indexed annuities. We grow cash value within the policy based on what indexes we're invested in. So we're not totally in the market, but we are in the market. So as that grows, I can take that cash value out in monthly payments or annual payments and supplement my income or supplement an emergency that I have and not have to pay taxes on it. And the big thing, Peter, in most cases, it's going to pass tax-free to my heirs. So when I pass away, that base value of that policy is going to be paid out and income tax is never paid on it. It's the only vehicle where I can take money out, get money from sickness, and get money if I die without taxes and never have to pay taxes on any of it.
And I know tax-free money is advantageous for anyone and everyone, but specifically, John, if we are of a certain kind of net worth echelon, like life insurance can play some strategic, specific
Mm.
advantages. If we max out all of our other available retirement savings
Right.
options and want to save even more, or even if like to an extreme level, we are subject to, or foreseeably our assets could grow to the place where estate taxes might be encountered, which by the way, they could lower the estate tax limit into the
Yeah.
future. But if we're there, right, we have different kind of financial discussions, different types of financial issues, but life insurance can play a significant value in our estate planning in that case.
Yeah, and it can also play a great value in other things. Walt Disney started Disney World by borrowing money on his life insurance policy.
Hmm. That was a good investment.
That was a good investment. Yeah. So, I mean, I had a policy. I take some money out. I get Disney World started. I pay the loan back, and I'm a millionaire. It's,
Yeah.
it's a no-brainer, Peter.
All right. So flexibility, a contribution amounts not capped like other
Yeah,
retirement options, the ability
yep.
to have that tax-free death benefit, tax-free deferral and growth of that cash value, the ability to borrow against it tax-free. So all of those. And now more than ever, John, the ability to cover the potential for some long-term care expenses by leveraging and utilizing the death benefit, having that available either or, and knowing that it's not use it or lose it. So again, tax opportunities. We're talking them through here with John Kuykendall. And here's the important fact, John. I don't want to understate this, is that not all of these opportunities are guaranteed to be around forever. The Congress can, has, and probably will in the future change the rules when it comes to our retirement accounts and the tax code. And so that striking while the iron is hot analogy here is like, let's take advantage of the rules how they are today before they get changed.
Yeah, I mean, Peter, we know that legislation changes all the time. Congress makes rules that changes how we invest. The Secure Act is a great one. For generations, ever since the 80s, we passed the assets onto the second generation and let them take it out over their lifetime. And that Secure Act changed it to 10 years. That was a huge change. So we know that legislation can affect how we do our planning. But, we have to do the planning. Sometime along the way, we have to sit down and figure out how we're going to do estate planning from a tax standpoint and how we're going to pass our assets on the best way without causing more taxes to be paid on our estate than we want.
Well, we always appreciate the time, the conversation with John Kuykendall, and today talking about a subject that is on the minds of pretty much anyone with income, and that is taxes. Always an important topic. And John, I want to finish this conversation with giving a high level of value that I feel intrinsically your firm presents to its clients that is not available everywhere with every money manager or broker or financial advisor. And that is that in many cases, when we are looking for financial and tax efficient advice, the saying is, well, we are not tax professionals. We can't give tax advice. This is just the investment portion, right? But it's your
Right.
firm and your sister company and how you integrate and communicate with the planning. You're taking a look from both the financial and the tax angles when you are making recommendations, understanding the implications and ramifications from both sides.
That's right, Peter. We have the software here available and we've had it for a long time now, that will put this year's taxes, what you're projecting you're going to do next year, or if you come in October, we put down how much we've made so far. It will tell us where we are tax wise, and then we can look at how much you put in your 401k, how much you set aside, what are some of the things that we can do to help lower taxes, and then we can either do that this year or we can do it. We can make those changes so they're effective next year so that I pay less taxes. Don't be like the individual that called me and said, I made $1.2 million in my company. What can I do to save taxes? And it's in February and his books close out on 12/31. I mean, it's already over. I mean, he owes that money. What we have to do is plan for this year, but don't procrastinate. Don't put it off. We have the software that we will help. We help all of our clients do this. It's what we call a tax comparison between where we are, where we're going, and how much it's going to cost me. And when we do that, Peter, we look at Medicare Part B and how it's going to affect you. Can I do a Roth conversion? How much can I do? If I do this, where is it going to put me in tax wise? Am I going to bump up to the next tax level, or am I going to be able to stay in that tax bracket? Sometimes you can do a 20 or 25,000 Roth conversion and stay in the same tax bracket because that's the things that we look for.
and know what rate you're going to pay on those dollars that you are converting. If you can control how much you pay in taxes out of those retirement accounts, that is a win, ladies and gentlemen. And if you haven't seen those forms show up yet, well, check your mailbox. They should be arriving. Deadlines are fast approaching. Taxes are on the minds of savers and investors. We want to pay less, keep more of our money, and we want to do that strategically, not just last year, not just this year, but for all of the years into the future. And that takes proper planning and coordination. And that's exactly what they do there at GulfCoast Financial Services. That's why they are continually named best of the best in financial services, have been for the last 10 years straight, concurrent and running by the readers of the Lake City Reporter. So pick up the phone, give them a call, drop by, have a conversation, find out why. If it's time to get that plan put together, review the current plan, they are there as your resource. No cost, no obligation to get your written plan, the financially focused written retirement income plan put together. Give them a call, 386-755-9018, 386-755-9018, 386-755-9018, or you can visit online, GulfCoastFinancial.net, GulfCoastFinancial.net. John, taxes, just another reason why quitting is for winners, but retirement is not for wimps.
That's true, Peter. Taxes are a major expense. We need to do what we can save them. And that book will help you a little bit understand more about what we have to offer and how you can do things to save on taxes, but also get ready for retirement. Retirement's not easy. It's not for wimps.
Yeah, and that is the name of the book. Quitting is for winners, retirement's not for wimps. If you'd like a copy, give a call, 386-755-9018, or drop on by the office there at GulfCoast Financial Services. They'd love to see you and meet you. All right, John, always a pleasure. We appreciate you talking through some tax opportunities with us.
Thank you, Peter, and happy filing. I hope you get your taxes in soon.
Be sure to like, subscribe, share, and tune in for more financial focus by visiting GulfCoastFinancial.net. The information presented on this program is provided for informational purposes only, without warranty of accuracy, completeness, or suitability for a particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature and not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs. Early withdrawals may subject the owner to penalties, fees, or taxes. John Kuykendall is registered with and securities are offered through Kovac Securities Inc., member FINRA SIPC, found online at www.kovacsecurities.com. Advisory services are offered through GulfCoast Financial Services Inc., a registered investment advisor in Florida. GulfCoast Financial Services Inc. is not affiliated with Kovac Securities Inc. or Kovac Advisors Inc. Past performance is not indicative of future results. All investing involves risk. Investment decisions should be based on your own goals, time horizon, and tolerance for risk. Due to various factors including changing market conditions and/or applicable laws, the content may no longer be reflective of current opinions or positions. GulfCoast Financial Services Inc. has been named as Best of the Best since 2015 in the category of Best Financial Advisor in the Lake City, Florida area. The award was based on receiving the most votes in this category from a survey offered and tabulated by the Lake City Reporter. No direct or indirect compensation was provided to the Lake City Reporter and/or any raters, and the award is not contingent on future direct or indirect compensation offered to the newspaper and/or raters. Portfolio performance is not a criterion, and voting is open to any readers of the newspaper.